In his world-famous book, Rich Dad Poor Dad, Kiyosaki tells us one lesson that is all you need to know if you want to become rich. You must know the difference between an asset and a liability and buy assets. According to Kiyosaki, this is the only thing you need to do if you want to achieve financial freedom. As a reminder, assets provide you with money whenever you're working or not, and liabilities will only cost you money. You may know what assets are, but what kind of assets are out there and how do they make you money? In this video, I will explain the 5 assets that I own in my journey towards financial freedom and how they can make you money. But first, what's up everybody? My name is Lucas and welcome on my channel, The Financial Collector. Please support my channel by clicking the thumbs up button, subscribe if you haven't yet and hit the bell notification to never miss a video. Let's dive in. Asset number 1. Real estate. Real estate is Kiyosaki's favorite type of asset. But keep in mind that he doesn't mean your house but income producing real estate. Many investment experts agree that real estate should be part of a well-diversified asset portfolio. Historically, the barriers to enter real estate investment used to be high, but a number of innovations have made it possible for every investor to start getting their feet wet with that asset class. Nowadays, you can start real estate investing with just a couple of $100. The best known way investors use to make money with real estate is by buying physical properties and renting or selling them. However, this will mean that you need substantial capital to pay for a down payment. It would also need some money left over for any maintenance cost. After buying the property, you need time to find renters, keep up to date with ongoing maintenance. You can of course do this yourself, but another option is to use a middleman. This will however reduce your profits a little bit. One popular option is to rent out some rooms or your current house, or renting out units in a multi-unit building you rent yourself. This is called house hacking, and it makes it possible for you to live for free. You can also make the decision to not own any real estate yourself, but to just buy real estate stocks. One of the popular options out there are real estate investment trusts, better known as REITs. A REIT is created when a corporation uses the money of their shareholders to purchase and operate income properties, like residential areas, commercial real estate or data centers. Just like other publicly traded stocks, you can buy and sell REITs on the major exchanges. Be aware that a REIT should use 90% of their profits to pay out as a dividend, so their payout ratio is much higher than other dividend stocks. This way, REITs avoid paying corporate income taxes, and is one of the many advantages of REITs. Some examples of REITs are Realty Income, ticker O, and Iron Mountain, ticker IRM. If you don't want the hassle of buying individual stocks, you can always choose to buy a real estate ETF. Some examples are the Vanguard Real Estate Index Fund, ticker VNQ, and the VanEck Global Real Estate ETF, ticker TRET. A fairly new way people use to invest in real estate is with crowdfunding. With crowdfunding, you become part of a larger group of investors that combine their money to purchase real estate deals, or to lend out their money so others can do that. The great thing about real estate crowdfunding is that you can start with just $50. Every crowdfunding platform needs to make money in some way. There's no such thing as a free lunch. The most common way platforms do this is with management fees or usage fees of the platform. Make sure you know the cost up front, because they can have a big influence on your potential return. If you are a US-based investor, Fundrise is one of the best known options out there. The downside of most crowdfunding platforms is that they aren't available for EU-based investors, but luckily they are on the rise. The only one I use is Max Crowdfund. Max Crowdfund offers real estate loans, where most have an interest rate between 8 to 10%. Asset 2. Stocks. When most people talk about investing, they mean stock investing. It is the most popular form out there and the cornerstone of many portfolios. When you invest in stocks, you are buying a piece of a public listed company. In this way, you become part owner of that company. Stocks can be bought through a broker, which buys the stocks on the stock exchange. The best known exchange is the S&P 500, representing the 500 biggest companies of the US. Generally speaking, there are 2 types of stocks: dividend stocks and growth stocks. It is a very nuanced view. Each type of stock has a different investment return and potential risk, but it will also depend on other factors like the current economy, political scene, or any ongoing worldwide conflicts. The products you use day by day are often made by companies you can buy on the stock exchange. Some examples include Apple, Coca-Cola, and Tesla. As an investor, you can decide to buy individual stocks, but another option is to buy a basket of the entire market. This can be done with an ETF, like ticker VOO for US investors or ticker VUSA for European investors. Making money on stocks can be done through different ways. One option is to buy low and sell high, where you're hoping that the price will go up so you can sell the stock for a profit. Another way to earn money from stocks is with dividends. There are companies that pay out a part of their profits to shareholders. Income-focused investors, more often called dividend investors, put a big emphasis on these kind of stocks. Asset 3. Bonds. When you buy a bond, you lend your money to a company or a governmental entity. You essentially become a lender. Bonds are issued for a set period of time, and during this period you will receive an interest payment. The best well-known bond is the US 10-year Treasury bond. Bonds are considered a more stable investment compared to stocks because they usually provide a steady flow of income, but with less risk also comes a lower reward. Some investors like to buy bonds the same way as stocks, individually. However, it is more commonly done by buying a basket through a bond fund or an ETF. Some options out there are the Vanguard Total Bond Market Index Fund, ticker BND, or the iShares International Aggregated Bond ETF, ticker EAGG if you live in the EU. When you hold the bond, you receive an interest payment, and after the end of the loan period, you will get the principal back when you buy an individual bonds. Asset 4. Cash. Cash investments carry the lowest potential return of all the asset classes, especially with the current inflation. But cash has a different role in your portfolio. Cash can deliver a regular income and can play an important part in protecting your portfolio and reducing the overall risk. Cash investments include the money you have on your bank account, and the high interest savings account, and the money held for longer periods in term deposits. The benefit for keeping your cash in a saving account with a bank inside the EU is that your money is protected until 10,000 euros. However, always check if this is applicable for your savings account. But if cash carries the lowest return, why have cash in your portfolio at all? The biggest reason why I keep cash is for my emergency fund. Whenever an unexpected bill pops up, like a medical bill, a car breakdown, or a layoff, you don't want to sell your investments. If you need to sell your stock, it will take time to transfer your money. In some countries, it is even considered a taxable event. A general rule of thumb is to have an emergency fund that covers 3 to 6 times your monthly expenses. For example, if your monthly expenses are around $5,000, then you should have at least $15,000 in your emergency fund. When you put your money in a savings account, you will receive some interest. The interest is paid out quarterly or yearly. Asset type 5. Cryptocurrencies. If the more old school asset classes are a little bit boring to you, you can add some exotic flavor with cryptocurrencies. The best known cryptocurrency is Bitcoin, but others like Ether, Ripple, and Litecoin are also getting some recognition. These currencies can be traded on online platforms. Like regular money, you can buy or sell goods or services with crypto, but it can also be saved for interest and traded on exchanges. Unlike traditional investments, cryptocurrencies are not issued or backed by a government or central bank. This will also mean there is no safety net. Crypto assets are very volatile and carry many risks. Fraud, manipulation, and cyber attacks are a regular news item in the crypto space. Always be careful and do your own research when it comes to cryptocurrencies. If it sounds too good to be true, it probably is. Many investors hold alternatives and cryptocurrencies in the hope that it will increase in value, so you can sell it for a profit. There you have it, 5 asset classes that you can use to achieve financial freedom. The list could be much longer. We haven't discussed P2P lending, commodities, or art. But personally, I don't own any of these assets, so I don't see a reason to discuss them. If they are a fit for your portfolio, great. With all your investments, always ask yourself, can I tolerate this risk? You are a unique person with unique goals and stress levels. Always do your own research with your investments. Never trust a stranger on the internet. If you want to learn more about personal finance, investing, or money in general, be sure to subscribe to the channel and leave a like if this video has helped you in any form. I'll see you in the next one.